Google trading lower today over the past 2 days. We're looking at losses of just about 3%. Now, this comes on the heels of two downgrades. Bernstein cutting its rating on the tech giant to market perform, but it kept its price target at $125 a share. This is the first time that Bernstein analyst Mark Shmulik downgraded Alphabet since he started covering the stock in 2020. And yesterday, UBS downgraded Alphabet to neutral, still bumping its price target up, though, by $9 a share. Alphabet, not the only tech giant with some of those downgrades over the last couple of weeks. Let's discuss it, what this means for tech going forward. Paul Meeks, Independent Solutions Wealth Management Portfolio Manager. Paul, it's good to see you here. So certainly some, apprehension, some caution here from Wall Street, particularly from the sell side, from analysts saying that right now valuations look stretched in some cases. How are you looking at this from a portfolio manager in your allocation?
So if you run a tech model like I do, you essentially have to be fully invested at all times, even a year like last year when you're trying to find the dog with the fewest fleas. Luckily, we're riding the momentum this year, though I will tell you fundamentally, I'm a little bit worried, actually more than a little bit worried about valuations here. And I think this downgrade call, two different analysts each of the last 2 days on Alphabet is legit, even though I love the company long term, and I actually think it's going to be a nice AI beneficiary. But these stocks have come so far so fast. And I'll tell you two things. We just got through another round of quarterly conference calls. I listened to all of them. And NVIDIA, all the companies talked about AI, and some companies not even in the tech sector. But then afterwards, the Wall Street analysts that cover the companies didn't really upgrade their numbers, raise their numbers for any AI benefit. And so right now they're talking, but they're not doing. I would say that NVIDIA is an exception because after their conference call, analysts quickly raised the EPS estimate for this year and next fiscal year by 80% each. Nobody else had that bump. So I worry about the AI hype. I was around when we talked about .com in the late 90s, and I still have the lashes on my back from that beatdown when the bubble popped. The other thing I would tell you that's interesting is tech and aggressive growth stocks need low interest rates. And a month ago, we all thought that the Fed was going to potentially, at least this was in Fed funds futures contracts, lower interest rates by 2 times before Christmas. Then we get through June 14th, and the hawkish pause is now telling us there's about an 80% chance they're not going to lower rates 2 times before the end of this year. They're going to raise them 2 times. So that hawkish pause is actually a real incremental negative. That with the AI hype, those 2 factors scare me. And so, yeah, I really worry about the valuations of tech stocks here.
So what does that mean for your portfolio? Are you taking risk off the table?
What I'm doing is I'm still fully invested, but I'm trying to embrace AI with some stocks that haven't moved as far, as fast just yet. And then I also try to play defense in other ways. But I think it's very difficult to try to time the market, go into wads of cash. And if you do that, because that was the right thing to do in 2022, and you don't reinvest, boy, you missed a huge move thus far in 2023. So to answer your question directly, within my stocks mix, try to play it a little bit more defensively than the other guy.
Well, Paul, then if you can give specific names, what are the best ways to play that with the defensive nature in mind, but also you don't want to totally miss out on some of this excitement that we're seeing in AI?
Yeah, so I own the regular cast of characters that everybody comes on the air and talks about. I just own them in maybe a smaller position size. I'll tell you the 3 stocks that I added in recent weeks to my Meeks Tech model. One is Extreme Networks. Now, Extreme Networks is not a household name, and so I'm playing some defense there because it's relatively cheap. I did buy some AMD, Advanced Micro Devices, to try to play, even though it's still fairly expensive. It's not NVIDIA expensive. And then I also added Uber, and I've been away from that company for years. And so these were 3 stocks. They've done well since I put them on my list, but I'm not just going after the same old like everybody else.
Well, what specifically you like about Uber?
I think Uber is interesting. Finally, a very visible path to profitability. So this year they'll be probably breakish even. Next year, they'll earn at least $1. And so at long last, you're starting to see some powerful operating leverage. In the meantime, their key compare Lyft is a company that's badly damaged, in a hell of a lot of trouble. And so their comparison just got more favorable.
On the flip side, Paul, what are some of the names that you've recently dumped from your portfolio and why?
One of the things that I did is I've been very disappointed in the lack of the rebound post-COVID in China. So I had played, as we got into late 2022 into 23, back in to some of the important players in China, JD.com, Pinduoduo, Alibaba, and unfortunately, we're not seeing the consumer spending. We're not seeing the economic bounce. And as you've seen in recent days, we're not worried about economic strength. Now we're worried about economic weakness in China, and the Chinese central bank is lowering rates to support versus every other central bank around the globe raising rates.
Finally, Paul, a name we've been talking a lot about over the last month, Tesla. What's your view on that stock in light of what you have said about the run-up, the enthusiasm that has been surrounded around tech, the concerns around the debt load, especially with the higher rates? How do you assess Tesla?
I think Tesla's a bit worrisome. I've owned Tesla from time to time over the years, never in a big way. You never really can value it as an analyst should. It's more a cult, and a cult of one man. But I would tell you that I'm gratified that they've become the go-to for charging stations and EV infrastructure. But on the other hand, you have a hell of a lot of either emerging companies and probably more importantly, legacy car makers that are coming to the dance. And so that in conjunction with Tesla's stock price, I'd probably stay away. Not to say I won't go back. I've been in the stock, but it'd have to have a pretty deep drop for me to get reinterested in Tesla at this particular price.
Okay, always good to get your takes, Paul. Paul Meeks, Independent Solutions Wealth Management Portfolio Manager. Appreciate your time.
Thank you.